This is the Traders Exclusive Live Trader Showcase for March 2024. This is a quarterly event where we feature expert traders to bring you training and insights from 20 different expert traders. So please check out tradersexclusive.com, where we regularly post articles and video clips with valuable trading tips and techniques. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. So I want to thank you all for being with us again. I'd like to introduce Martha Stokes of TechniTrader is here with us today. She's going to talk about how to see the inside market activity. She is the CEO. She is a CMT also. She is the CEO and co-founder of TechniTrader. She's a retired professional buy-side analyst who has been working to educate traders and investors at all levels since 1998. She's managed a successful fund and trading floor, owned and sold several businesses, and taught at several community colleges. Martha is a longtime charter holder and member of the CMT Association. She earned this SEC-recognized designation with her thesis called Cycle Evolution Theory, and has more recently submitted her work on relational technical analysis to the CMT Association. These concepts are the bedrock of TechniTrader's trading education. And I will now thank you for being with us, Martha. I've emailed before and hoped that you would come, and so now it's awesome to have you here. And
thank you.
Can
you see my screen, and I have my camera on. Can you see both?
I can actually see. No, I can't see your webcam. I just sent the request, so it should turn on for us now.
Should be now.
There you are. Hi. Good morning.
I love teaching in my retirement. It's very exciting. I have had many students go all the way to professional traders and actually managing 100 million hedge funds. So I'm very excited because there's all kinds of opportunities in the market beyond just trading as you are. So I'm going to talk about how to see the inside market action, because that is where it all begins. She has explained the disclaimers. I have the same disclaimers. Everything is copyrighted, but you can watch this video over and over and over as many times as you want. We have videos on our website as well, so that's really good. She's done a good job of presenting me, so we don't need to go through this anymore, but I always have this in case the presenter doesn't do that for me. And then we're going to get started. What is the inside market? The inside markets is where all of the various professionals of the market transact the business of buying and selling stocks. It is not on the public exchanges. This inside market is also known as dark pools of liquidity. Dark refers to the fact that none of these transactions are visible during the day on the public exchanges, where you and all the other retail traders and small funds managers buy and sell stocks. When I speak of a small funds manager, I'm speaking of a retail side. The SEC has determined that anyone who's a small funds manager who has less than $3 billion of assets under management is no longer considered a professional, but a retail side. So they're on the retail side. Pools refer to the massive quantity of stock and capital available in the hidden venues you cannot see during the day. There are over 100 trillion, and yeah, that's trillion dollars in assets worldwide on the professional side of the market. It's enormous. It's mind-boggling. Liquidity refers to the transaction time, which is on the millisecond scale. Impact of dark pool activity for financial markets. Alternative trading system venues, ATS, also known as dark pools liquidity, have been around now for over 20 years. So if you're just hearing about it, you have a little bit of catching up to do. These dark pools, with their peer-to-peer over-the-counter transactions, are intended to eliminate or at least minimize front-running of giant lot orders by HFTs and retail groups. Dark pool activity now constitutes a huge majority of all financial market transactions. Now, why would we do that? Why would the SEC approve that? Why would they take the dark of these massive amounts from the buy-side institutions, your mutual funds and pension funds, and allow them to trade where you can't see? because they are entrusted with the fiduciary responsibility of the millions of families who have 401ks and other investments in the stock market. It's their responsibility to protect the average investor's investment. So they don't want any front running that causes disharmony and creates problems for the dark pool buy-side institutions. With over $300 billion changing hands every day in the stock market alone, the magnitude of the dark pool's dominance should not be underestimated. This is an area of study that both retail and professionals need to learn and stay current with. How these dark pools influence price trends and bull to bear cycles. It is not what you think at all. There are currently 50 ATS dark pools, that's their alternative trading system venues, offering these hidden venues for the giant large buy-side institutions. NASDAQ has a private dark pool. New York Stock Exchange, ICE, has a dark pool. A lot of the banks have a dark pool. So there's 50 of them, and they're very active. And the bulk of the transactions are happening hidden from view, especially for you retail day traders. Why this matters: the majority of the stock and financial markets use fundamental analysis with quantitative formulas and analysis to determine where they're going to buy or where they're going to sell to lower their inventory. When they're lowering their inventory of a stock, they never get rid of all of the stock if it's a big blue chip, but they can lower or raise that at any time they want. But what they do is they call what's called rotation. They slowly sell shares of stock on a penny spread. I'll talk about this a little further. However, all fundamental data that is reported quarterly or even monthly is historical data. So if you just rely on quarterly information or quarterly earnings or news, you're looking at the past, not the present. It is not what is happening at this moment in time for the company and its stock. Relational technical analysis is my term, and it was my thesis that was approved by the CMT. Uses current data compared to historical data with an understanding of how dark pools impact price and indicators to provide a complete analysis. In other words, we're able to understand what's going on just looking at the charts, because at the end of the day, all that dark pool data is put into stock charts. So you have it there, but you have to learn how to find it. Fundamentals do show up in the stock chart if you know what you are looking at, what the candlestick indicators and trends are indicating. I can look at a chart and say, okay, this is where the fundamentals lie right now. This is the price range of fundamentals, and we can check to see if fundamentals are above or below price. And this matters because if you're speculating and it's well above price, it will collapse back down to that fundamental level. Understanding where to find dark pool activity on the stock chart gives you the ability to trade a stock before the huge runs up. Dark pools are always the bottom makers. They make the bottoms, and they if they're selling and rotating out, the topping action starts to curve as they slowly rotate out. But they are always in the bottom, and their buy zones are fairly large on this level because the stock's price is below the fundamental values. Pro traders use little nudges, which you can use if you're a pro or semi-pro or just starting out. You can learn the little nudge candles, and then that drives the little momentum runs up that a lot of people trade with. Consolidations like this are pro traders nudging the candles and then another move up. This is another buy zone up here because the fundamentals have moved up over time, and now the fundamental levels are here. Again, you have your nudges going on with your pro traders, and then it runs up further. So you can learn to get in here as a platform position trader and just wait for that to move up if you only want to trade a few times a month and you're working full time, or you can be a swing trader, which is better than day trading. It's far more lucrative and less risky and less regulations and restrictions. And then you can ride it up for several days and sell when the pros sell. What are dark pools and why are they legal? Dark pool venues, or ATS, started out with a few giant funds requesting off-exchange venues so that the then new high-frequency trading systems would not front-run their buy orders. What happened is in 2002 is the market went from fractions to decimals. Well, when it was fractions, the SOS bandits and the floor traders who'd gone rogue and were trading on computers and making huge amounts of money were front-running the market on the exchanges. When it went to decimals, they had to go to high-frequency trading, massive computers that can trade on the millisecond and plug right into the exchanges to make any money, because it's just a penny. How do you make a penny? You have to have 1 million shares you're running. Million shares, lot orders, huge. So the dark pools didn't want to be front run anymore, so they asked and the SEC approved. HFTs are fully automated trading systems. They're all programs, and yes, they use AI, and yes, HFTs make a ton of mistakes. So you have to understand the HFTs as well, because you're going to be trading against them, with them, or chasing them. The off-exchange transactions in 2005 accounted for less than 5% of the activity of the stock market. Today, dark pools contribute approximately 50% or more of all transactions all across all of the 7 financial markets. Large lot professionals transactions include dark pools constitute 80% of all the market activity. Hence, the retail side of the market, despite its millions of investors and traders and pension funds, accounts for only 20% of all the transactions daily. That's very low. Public exchanges show only the retail groups and small funds activity during the day. A lot of people say, oh, I have whales. I can show you where the whales are, the big dark pools. No, they can't. You cannot see the dark pool activity during the day. You can see it after when that clears the national clearinghouses. What you're seeing is small funds managers trading 50,000 or 100,000 share lots. That is not a really big lot anymore. Who are the dark pools? The most important and influential market participant group trading in the financial markets today are not the big banks. Retail news is always talking about the big banks, the big banks, the big banks, the financial services. They are not controlling the vast wealth of this country. The buy-side institutions, now commonly referred to as dark pools, control $100 trillion assets worldwide. The dark pools consist of giant buy-side institutions, which are mutual funds and pension funds. We have 1,000 Fortune companies, and they all have pension funds. And we have a lot of mutual funds. We have 30,000 different mutual funds available. Derivative developers, ETFs, all these, the new crypto-based, these are like State Street, BlackRock, so on. Large buy-side institutions who qualify to trade on the alternative trading venues, who are the pension plans and mutual funds that are not at the giants. The giants are about 20, 25, derivative developers about 10. Large buy-side institutions, there's about 100 to 150 in any given time. All of these companies are huge corporations or global conglomerates. The banks are sell-side institutions. The banks are short-term trading activity, making the market and making a lot of money, especially when the market goes down. So they're always promoting, oh, recession, oh, inflation, oh, the FOMC report, and trying to scare people to sell, because that's where they make their money. Statistics of dark pools. Retail brokers are required by SEC regulation to like all retail orders before either filling from the broker inventory or sending to a market maker under the Payment for Order Flow Protection Plan, which is PFOF. You now get to trade for free. Oh, it's free trading. It doesn't cost you anything. It does. You just don't know where the cost is coming from. It's coming from the PFOF or from the broker filling the inventory. They have a minute to fill your order, and they can wait and tick up and down and make profits that way. It is not free. Retail orders must be filled in a minute or less. Most dark pools average a 10-minute fill if they have a million lot order. So they're slow accumulation, gathering from wherever they need and from others, each other, what they need as far as their fill. They don't have a better price than you do because they strike the penny. The SEC has been watching them for years. Huge block orders take longer as they gather vast quantities of shares across many venues and exchanges. Dark pool orders are permitted to delay reporting to the national clearinghouses. These orders typically are sent after the market closes. So I have these market condition analysis scans that I have that I can't show you today, but I analyzed the whole market because I needed to do this for my trading floor. And I needed to have more than futures because futures weren't working and how the market's going to open, and the indexes don't do any good at all. So I made these. And so I saw that I had to wait 1 to 2 hours before all the data would be put into the charts so I could see what was going on. So it takes that long. There's a lot of money moving around. This means that any retail day trader trading does not see any of these transactions. So you're in a stock and you go, oh, go up, please go up. And then suddenly it goes down. That's because they're trading on the millisecond and you're trading on the minute. Dark pool orders are a minimum of 100,000 shares to block orders as large as 25 million shares. The other day, I saw a 120 million block order go through in the early morning before the market opens. I do a market report, market condition report, and a market open report for my students every single day so they know what's going on, and I have a couple charts for them to look at. Dark pools, this is the SEC Midas. You can get this on the SEC website. I encourage you to check them out and read all their articles about retail day trading, because less than 1% of retail day traders actually are successful. And a lot of you are trying to day trade, and it's a bad idea. Go to swing trading, platform position trading, momentum trading, intermediate term trend trading, whatever is useful to you. But try to get out of the day trading syndrome. The professionals don't day trade anymore because there's no money in it. Dark pools are down here. They have a controlled bracketed order, and you can see they rarely go outside of that range. This is high frequency trading activity, creating high liquidity as maker takers. They earn money from the exchanges for providing liquidity by offering to buy or to sell. These are your small funds managers. They're often speculative. They have no education to very little education. A lot of them are new to charting and technical analysis. They don't have any SEC series licensing, but they trade actively. And here are the retail groups trading actively. So that's what it looks like on the SEC Midas. There's also the CAT. The CAT is a consolidated audit trail, which tracks every single transaction, breaking it down to, because there's lots of transactions being filled in certain areas, breaking down who did what where. So they know what's going on, so they can penalize and fine people who do bad things. With their ability to trade on the penny spread, dark pools can control the movement of price up or down with minimal impact on price range while they're in accumulation mode. Rotation also functions similarly. That's slowly selling out of a stock because it's reached the business cycle peak and it is going to reach market saturation. They're going to be out before the downtrend occurs. Dark pools tend to use quantitative analysis formulas to determine the price range within which they will buy or sell a stock. Very tight range. Now, penny spreads. I call these narrow ranges of horizontal trends buy zones and sell zones. This is a millisecond scale, by the way. If the stock moves above or below the range designated, then the dark pool, time weighted at price or other bracketed controlled orders, halt and pause. So if the professional trader nudges it up and it goes above, they halt their trading. And retail and professional traders nudge it again, and then smaller funds get in. And then suddenly retail traders see it and they buy up, and HFTs are front running them all the way up. So it's a fun game for them. This creates a pattern that can be identified using relational technical analysis. So we're looking for these dark pools. We're looking for the nudges that pro traders are nudging that price before it runs up, because you want to get in before, which includes studying of the price action, the trend behavior, and hybrid leading indicators with an understanding of dark pool activity. Hybrid leading indicators track large lot versus small lot, uptick versus downtick. What side did the dark pools tick on? So typically in your chart, you're going to see these little consolidations. These are platforms, and sometimes you'll see a gap up. You want to be in this before the gap up, and platform position traders can trade these and have a slow, steady increase in capital and have monthly income from it. And it works very well. I have a lot of people who work part-time or full-time. They still want to trade. They need that extra money because they're squished between inflation and other problems. And so they are able to platform position trade. They go in on Fridays, they check their charts, they choose some stocks, they position trade, and then they just wait a few weeks and the price goes up. It's very lucrative. I have one lady who worked, whose husband was a high person in Boeing, and she said, Martha, I made more money trading position trade than my husband did. So I was like, that's great news. What most technical traders miss, why they miss the buy zones. Most technical traders miss the buy zones because they use outdated price and time indicators. Price and time indicators were written prior to the dark pool venues. Dark pools do not disturb price by moving price up or down. Hybrid indicators reveal dark pool activity because they're able to track where the large lots are happening. These indicators incorporate more data in a sophisticated formula. Some define which side of the transaction the large lots dominated. Data must include uptick and downtick. These are indicators that are usually not public domain. Okay, so you have to find a place where you can get these. These indicators are part of the TechniTrader courses. I've designed and developed quite a few of them for various charting software companies that I deem very good. So we can track with these indicators whether they are accumulating or starting to rotate out. These indicators are very good. They often signal with a high spike before it goes down. So for exit strategies, it's also very excellent. How do you currently trade? Trading styles or intraday, day investing for retirement is a lot of what you people are doing out there. Or are you trading as a business? Trading as a business is an IRS status that allows you to trade, to act as a business in trading, and it gives you all the deductibles that you can have as a business. It is used by all professionals on the professional side, where they're independents and they're making money, because they can deduct all of their expenses. Their inventory is stocks, and at the end of the year, they can close out with zero inventory, and it's a huge asset. Hobby traders is what the IRS calls most regular retail day traders. They are not allowed to deduct if they have a loss. They're not allowed to deduct their expenses. They're not allowed to do anything with their inventory at the end of the year. They have to consider it a capital gain. So you have these problems as a day trader, and you want to eliminate them. Indicators, are you using just price and time indicators? Or are you using quantity and large lot versus small lot indicators? Entries, are you using indicator crossovers or reversal and continuation candle patterns, which are unreliable in our modern market because they were written for the Japanese rice commodities exchange of the 1600s. Ours is a different market. Or have you learned the candlestick buy and entry signals that work on our modern markets? There are candlestick buy entry signals and sell entry signals that are not in the reversal and continuation candles books or webinars that you see. Stop losses. Are you using percentages? Don't do that, because everybody knows that you use 8% or 10% or whatever, and they're going to go, okay, I'll take you out. And so you're at a loss, and then the next thing you see, your stock is just going like, and you're not in it. Or technical support levels that are appropriate for the trading style you're using. If you use technical support levels for swing trading, technical support levels for position trading, technical levels for momentum or velocity trading, you will not be using percentages which the HFTs just take out like this, boom, 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 all day long. Goodbye. Finding stocks, are you using news, gurus, and recommendations? Bad idea, because HFTs know, and they check this out with their AI, and they know what you're looking at. They know what all the chat rooms are doing. Or are you using charting software scans, charting software sorts designed to find dark pool buy zones so that you can monitor these and get in at the nudges that the pro traders do? Determining market conditions, are you using futures, retail news feeds, and indexes? That's not enough. That's part of it, but not enough. What I have is my market condition analysis and market technical indicators that help my students, and I show them how to use them. The difference is, are you trading like it's 1999? Or are you trading the current market with all the variables and new trading instruments that are available to you? Beyond the basics of technical analysis, if you want to be a consistently profitable trader, you need to learn more than just the basics of technical analysis. That's the beginning. That's ground school. The basics are a good start, but in order to make the income of a professional trader, you must learn more than just candlestick continuation or reversal patterns. You need more than just MACD, RSI, Bollinger Band, stochastics, Fibonacci, or Elliott wave theory. These are fine, but they're all price and time. And price and time doesn't track the dark pools. All professional traders incorporate far more advanced indicators called hybrid leading indicators. These indicators signal before price moves because they're not based just on price. Again, dark pools are very controlling their price. They're striking the penny, boom, 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 because they use time weighted at price. Market structure basics. A professional trades very differently from a retail trader. You would be astonished. I go to trading floors and talk to the floor traders and see how they're doing. They are aware of the entire body of market participants, what each is doing, and how that market participant group impacts price action. They are aware of who they are trading with and who they are trading against. They see all four positions within a trade. What are the four positions within a trade? A buyer, a seller, someone selling short, and someone buying to cover. They understand the enormity and complexity of the markets. Professionals use special order types and commonly trade 1 to 5 million shares in a transaction. You don't see those transactions on your public exchanges, folks. They use special indicators designed to identify which side of the transaction the large lot triggered. Then they know where to go. Boom. And they're swing traders. They don't day trade, I would say the banks and the sell shorters day trade, but not the independent traders and professional floor traders. Independent professional traders hunt for dark pool buy zone activities because they know that there's this huge liquidity draw going on over several weeks or several months. And that when price starts to go up because of the liquidity draw, it's going to go like a rocket. And that's what they hunt for. They create candlestick patterns called nudges, which trigger HFT automated orders. I call it nudges because it's a very small candle, but it's enough volume, enough activity that it triggers the HFT. They have it all figured out what the HFT programs are writing and doing, and so they control the HFTs. Foundational knowledge. There are 6 primary market conditions: bottoming, trading range, platform, moderately trending, up or down, velocity, up or down, topping market conditions. So the bottoming market is always controlled by the dark pools. They slow the runs down because they're starting to accumulate when they see the fundamental levels are there. The bottom often goes below the fundamentals and then moves up rapidly. Trading ranges, these are when the dark pools are not buying much stock or selling much stock, and they're huge, wide swings. Platform market is when the dark pools are in total control of price with HFTs in between. This is because the retail side is scared to death. They're hearing all this bad news. Oh, it's terrible. Oh, it's scary. All this stuff. So they're afraid to trade or invest. Moderately trending up or down. That's what we're in right now. We're in a moderately uptrending market condition. Velocity market is when things go speculative. You call it overbought. It's not overbought. It's speculative or gambling mode, up or down. And topping markets, which are created by the decline of revenues and earnings and the deterioration of the fundamentals. Each market condition is unique. The trend line patterns, which none of you will learn because I'm the only one that teaches them, within the trend are different. This is because different market conditions are created by different market participant groups dominating and controlling how price moves up or down. Market condition is your roadmap for navigating the market activity over time. You will trade differently in a velocity market than in a platform market. The stock market cycles. There's this big, huge bull market we're just beginning, 10, 15 years out, maybe longer, and then a bear market, 1.5 to 2 years. That's the cycle. And each market condition is different in that part of the cycle. So it changes as we go through it. All of you have probably heard about the Dow theory of 3 levels of market participants, and you all probably think that this is where it is. This is the Wall Street, and this is the Main Street. It doesn't exist anymore, folks. I know you hear this on the retail news. I know they talk about it all the time, but it doesn't exist anymore. So this is what exists. I don't have time to go through all of this, but I do have webinars on my website that you can see if you want to understand this in more detail. What I have is the bull cycle of market participants. The bull market is long, it's enduring, it has corrections and corrections and corrections. And at one point it peaks and it starts to go into a bear market. 20% of the market is controlled by the retail side above this red line. These are all retail. 80% is controlled by the professional side. These are all professional side. HFTs front run you, front run asset managers, front run sovereign, and everybody. Odd lot investors are the last to get in. They're the ones that create gambling mode speculation. Retail trading chat groups get in late because the gurus are controlling that. Small lot investors wait and buy on a dip. And memes groups and retail traders are in and out all the time. Small funds managers get in a little sooner. Dark pools, this can be a weekly scale, a monthly scale, a 15-year scale, but this is how it works. Bottoms are started by the buy-side institutions. Wealthy private investors are billionaires like Jeff Bezos. He knows business. He started a small business and now it's a mega conglomerate. And so he's very savvy about business. Why is that important? Because the stock market is the business of businesses. If you understand business, it's a whole lot easier. And the professionals are all over the place, buying and selling. We have the sell-side institutions acting as market makers, Corporations also invest in the market. They may be doing buybacks of their corporation, buying back shares of their stock to lower the liquidity, to make the stock go up. That's the whole purpose. That's the whole purpose. High frequency traders are constantly trying to front run anybody and everybody they can. They can't the buy side and the wealthy investors because they're not trading there. So on the bear market cycle, what happens is just the opposite. Small lot investors get out at the bottom when the buy side institutions are starting to slow down the descent, and they're starting to buy because fundamentals are up here, but they're capitulating and giving up. Buy side institutions start rotation slowly and they bend. You'll see the bend in the trend because as they slowly rotate out, it starts to bend the trend. Sell side institutions get out, start selling short way before the market actually starts going down. It may still go up and they start selling short. Professionals, all these start selling short. HFTs cause the huge gap downs and their buy to covers are way down here. And meanwhile, some small lot investors don't realize it's a top market and that it's a bear market. And so they're still buying on the dip and buying on the dip. And then of course they give up down here. You've got to learn more than you know because you're blindsided, you're blinded when you don't learn all these things. Market participant groups, you need to learn why and how each of the 12 market participant groups affect price and volume and how they affect it. Each group has a distinctly different footprint on the stock chart. And if you learn these, it's like reading a book. As soon as you understand, oh, this is what this group does. Oh, this is what this group does. Okay, I've got this. Within the group, the trading activity is very similar. You must understand the wide disparity between the groups in terms of venues. Are they trading on lit public exchanges or the dark pools? Or buying directly from the company? What order types are they using? A lot of you are hearing about VWAPs and how great they are. VWAPs are the most dangerous of all the order types. Why? Because it's volume weighted at price. Smaller funds are using these all the time, and that's why when smaller funds start selling, it accelerates dramatically. If you know that VWAP orders are out there triggering, if you got in earlier for a sell short, you could just write it down because they're going to sell that down with that VWAP because it's exponential. Lot sizes. Professional traders 1 to 5 million. Intent of the trade, long-term, short-term, swing trading, market making. Over the past few years, the financial markets of the United States, especially the stock market, have fractured into multi-venue structure that has never existed before. So you read these books that were written 50 years ago, or 10 years ago, or 5 years ago. It's different, and you need to learn it. Relational technical analysis makes it easy to recognize each market group's footprint in the chart. That's why I developed it, because I wanted my students to say, oh, okay, this is a pro trader. Oh, this is dark pools. Oh, these are retail traders. Oh, this is an odd lot. It makes it so much easier to trade. It just makes it easy. Market condition analysis tells you who is in control of price, what technical patterns are prevalent and reliable, how price will behave at resistance and support. It changes. What trading styles work best at this time, which indicators to use, the inherent risk in trading specific styles, what trend line patterns are common, which entry and exit signals are most reliable, the strength of the price and volume patterns. Market condition analysis tells you how and when to trade, who is controlling price, what to expect in near-term price action, where to find excellent picks, how to enter, and when to exit. Gone. You don't need recommendation services. You don't need the chat rooms. You don't need the gurus. You get in before all that happens. You make a whole lot more money. You go, wow, Martha, this is really cool. I'm having so much fun. Market condition analysis is a roadmap of which market participants are actively trading, which are sidelined or waiting, and where they are in the overall long-term, intermediate-term, and short-term trends. So you got to understand this. It's not hard. It's actually fun. It's exciting. It's like, wow, I didn't know this. It's like being a teenager again and learning all this marvelous stuff you never heard before. It's exciting. This provides the relational analysis needed to navigate the complex marketplace we have today. So one of many relational technical patterns that reveals dark pool activity is the shift of sentiment pattern. It's a shift of sentiment. So it was selling down, selling down, selling down. Yeah, I don't have the full chart. And then all of a sudden there are gray bars. And that says, okay, dark pools are here. And look, oh, little dark pool candle patterns. Little nudges by pro traders. Okay, we've got this. This is a combination of candlesticks and hybrid leading indicator patterns. The shift of sentiment pattern occurs as HFTs search for the dark pool's liquidity draw. At times, often at times, HFTs trigger orders just accidentally trading against the dark pools, selling a gap down. This goes, the HFTs gap the stock down and then run it down and go beyond the fundamental level. Dark pools surface, bye, 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 bye. This creates a temporary one-day sell down, which often reverses the next day or the same day. I'll show you a pattern where it reversed exactly the same day. Extreme price action is caused by HFTs, not dark pools. The shift of sentiment orders occurs prior to the HFT action on the upside. This identifies the buy zone. You go, oh, buy zone, okay. And then you wait for an entry signal and you get in and you write it up. Candlesticks have specific formations on the chart, so you know what to look for. So stock has been selling down. It starts with market makers selling short, banks selling short, positioning, and okay, there's a buy on the dip because the retail side doesn't know that this is so buy on dip, but it still goes down, it still goes down, goes down and goes down. Suddenly there's capitulation. I'm giving up. HFTs are these long volumes. If you see long volumes, write this down. This is always HFT action. And so all of a sudden, the selling is slowing down, slowing down. We have these small candles that are appearing, and we have a buy zone. And slowly, all of a sudden, pro traders, oh, we have a buy zone, push it up. We have a buy zone, push it up. We have a little signal. Pro traders are getting in this nice velocity run right there. And then another little run up. Now a little correction because it's gone below, it's gone above the buy zone. So they stop buying. So it's a whole cycle that goes on, and you can learn to read this, and it's a lot of fun. HFTs are high-frequency trading companies. They are maker-takers, providing liquidity to the public exchanges. HFTs are not allowed on ATS dark pool venues at all. They tried to get on during the pandemic, and the SEC slammed them with fines and penalties. No, you will not get on this. And then they slammed the banks and NASDAQ and New York Stock Exchange for allowing them on. So they're not on there. HFTs are just the opposite of the dark pools in terms of price action and candlestick patterns. What does that mean? HFTs want huge gaps and huge ones down because they are selling short. And as you buy, they, or sell or buy to cover, then they're on the other side of the trade. So they make a lot of money. HFTs are trying to force price to move quickly and in large volatile or velocity intraday patterns. All of the gaps at market open are HFTs. All of the gaps at market open are HFTs. Write it down. Gaps at market open are far more prevalent in recent years than other prior decades. They're all over the place all the time. These huge gaps, especially during earnings season. HFTs go out and they go hunt. Okay, this company's reporting today, and it looks like they're going to miss their earnings or their year over year. All right, let's gap this baby down. So everybody's selling and they're buying to cover. Then you're selling because I don't want to be in the stock. Yeah, you have to pay attention to what's going on because you're not making the money you deserve to make because you work hard and you've earned your money and you're trying to learn to trade this stuff, but you don't have all the information. So it's not your fault. Huge gaps and extraordinarily long candles are the primary candlestick patterns from HFTs. So anytime you see a huge volume spike and a huge volume gap and run down, that's HFTs. You can't chase them. You can't chase them, never chase them. Smaller funds as well as the retail traders investors are often chasing HF activity without realizing it. So they gap it down. You freak out and you start selling. They're buying to cover. And their buy to covers are way down here. So they make a lot of money. HFT candles are typically one-day events and often do not change the trend. So you're not going to have a change of trend. Dark pools change the trend because right here is a dark pool zone, buy zone area. And all of a sudden the HFTs go, oops, we were on the wrong side of the trade because the company had good earnings report. And so then they gap it back up. Okay, so you have indicators that tell you that it's HFTs. Pretty easy to see on the chart. Let's talk about order flow. High frequency trading firms use formulas to find anomalies in order flow. a normal order flow pattern when you're not using chat rooms, when you're not reusing recommendations, when you're not relying on a guru, but have the confidence and ability, skills and talent to do it yourself and find stuff and be trading with the pro traders as random. Pro traders don't tell each other what they're trading. They don't sit in chat rooms. They don't talk to anybody. They're very reclusive and they are not going to help you out. They're not. So don't ask for that. When cluster orders are identified by the quantitative analysis formula of the HFTs, it triggers automated electronic orders that cause whipsaw action or extreme patterns before the market opens. So we have all these orders that the retail brokers are required to show before the market opens, just before the market opens, all these cluster orders because, oh, chat room, oh, guru, oh, memes group. Okay, we're all going to be trying these stocks because we just know these stocks are going to go up, yay. And and so you create cluster orders and HFCs say, oh, this is just too easy. The program clicks, fills the queues with their orders, the computer orders, the computers that run the order open, market open, making sure that there's no arbitrage, adjust the orders, the sell the gap down because there's so many sell orders. So they adjust it down, opens down, and then you're trying to buy on a market that's selling down. All high frequency trading is done via computer generated order. There are no humans trading at these computers and they make mistakes. This can cause major price trend disruption, mostly intraday, huge volatility. Retail day trading has become much harder, if not impossible, because of this. SEC says about 1% of all people who try to day trade are successful and most lose all their capital and owe huge margin calls. Don't try to day trade. It's not the market for you. You're trading on a minute scale. It's impossible. Using indicators properly. In order to use any indicator or market indicator properly, you must understand more than a crossover signal. What is the indicator category? There's about 8 different categories. What market data is used in the formula? What market condition was underway at the time the indicator was written and the intent of the writer? George Lane wrote stochastics in the 50s. What was the market condition? It was a trading condition, trading range condition. So he wanted to know the highs and lows of that range. What are the limitations of the indicator? MACD is a momentum indicator. And so it's designed for momentum. Gerald Apple wrote it, and there's limitations. When we go into a velocity market condition or a platform market condition, it fails all the time because it whipsaws constantly. Is it for short-term or long-term analysis? I go and check out people that are saying they're having trouble that are not my students, and they're using OBV. It's like on-balance volume is for long-term investing, or they're using a short-term indicator for long-term analysis. What indicator patterns form and what each means? There are indicator patterns within the indicator. Under what trading conditions does it work best? Which sub-indicators to use with the indicator, if any? I always advise subordinate indicators because they really help. The exact formula is only useful if you are a mathematician and wish to alter the formula for your own use. When you alter an indicator, it becomes a proprietary indicator unless you release the formula. More and more indicator writers have suddenly discovered that, hey, I can't make money just giving it out to the public as the original indicators did because I don't make any money on it. So now the best indicators are proprietary, and that's what you'll find. Data used in stock indicators, price, time, and quantity is all you get. 2 data are needed to create a stock indicator: price and time, quantity and time, and price time. Indicators lag all the time because why? Price has to move before the indicator can signal. So it lags. Quantity and time indicators sometimes lead. This is better. This is volume, quantity, large lot versus small lot, that sort of thing. Price, time, and quantity indicators are the new indicators called hybrids, and they lead most of the time. Why? Because hybrids reveal dark pool activity. They reveal professional nudges, that type of thing, because they're more complex formula. So they are able to see those. These hybrids are not public usually. There are a few, but not many. So what you want to do is price and time lags. That means on a penny spread, decimal penny spread, you can't afford to have that indicator lag. It has to be leading. It has to tell you before price moves. You have to do that. So you have indicators indicating that the stock is going to move up. You see a little nudge right here. You run up. You see another nudge that they're going to sell. You sell so that you can get out at the same time as the pro trader before the stock runs down. If you're a swing trader, this is what you need to learn. Okay, I promised you. This is a fundamental buy zone. This was a fundamental buy zone. It moved up because fundamentals improved before the report was out. So the buy-side institutions continued a quiet accumulation right in the middle of this range. Ping, 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 ping. HFTs tried to gap and run this stock down. It started down like this. It dropped right into this previous buy zone. Boom. I'm sure you've seen this. This is called a pole vault. This is a pole vault candle, and it signals a reversal of trend. So the dark pools came in, and on the rare occasion, they're buying it until it gets back into their buy zone, and they stop. Pro traders push it up. So you have to be aware of these things. You have to be aware of when the pro traders are going to break it out and have strong velocity. So you can see that fundamentals are in the charts. You don't need to study all the fundamentals. You can get it. Dark pool buy zones are not a momentum price action. Write it down. Dark pools are not a momentum price action. They strike the penny. The dark pool's intent is to not move price, but to strike a penny spread, to buy at a desired price within the set price range. I can tell you the floor traders of the buy side institutions, and they have 100, 200, 300 floor traders on a floor. And when they hit that, when they send it for routing, they hit that penny spread on the millisecond, they're excited because that's what they're supposed to do. Hit it on the penny. As the dark pools buy over many weeks and months, they slowly impact the liquidity for that stock. They're putting these in a trust for an ETF or a mutual fund or a pension fund so they can build indexes. So it pulls the liquidity from the retail side. That creates a liquidity draw that professional traders can identify with relational technical analysis, and so can you. When pros find the liquidity draw, they begin buying the stock for a short-term trade. This creates more demand and volume increases. At this point, the stock is poised for a sudden huge gap or large up day by HFTs or memes groups or other people. The dark pools cease their automated buy zone orders as soon as their pro traders start moving the price up, waiting for professional traders to move it up, then HFTs, then the smaller funds run in, and then the retail crowds and the retail chat rooms and the meme groups start buying the stock in the final surge of the run, creating the speculative momentum runs that always follow dark pool buy zone completions. So I have a few minutes to ask questions, but I do want to present my opportunities for you to learn more. I'm very excited. If you have been trading for a few years and are 5 years or 10 years or even 2 years experience, please check this one out. This is a professional trading plan. It's a mini course. It shows you how we teach and what we teach. And it's my most popular mini course, and there's no charge. You just have to register for it. We don't hunt you down and bug you all the time, because after you've taken this, you'll know if we're right for you or not. It's just that simple. If you're a beginner with less than 2 years experience, you want to start probably with the candlestick patterns or the leading hybrid indicators. I'm not saying that all of these aren't valuable to you, but I'm saying that where you should start. Once you've had these, if you feel like you want a little bit more, you can always, and we have other free mini courses as well. But these are the most popular ones that we have for beginners, for experienced and advanced, and those who want to become semi-professionals. And I will soon have one out as trading as a business, so you want to check for that one as well. Right now, I'm going to give you a gift. This is Relational Technical Analysis. This is a video training course on our website. It costs $99 to watch it normally. This is your free gift. If you want to type that into the chat group so they can all get that, I would much appreciate that. You have 24 hours to enroll free. You have free access for 1 week. You can watch it 15 times, 20 times, however long you want. And it's a video lesson on relational technical analysis. There's areas that I couldn't cover in detail right now. So I'm happy to take questions at this point. So anybody have any questions for me?
Okay, I'm going to pop them out. I could change it so you could see them yourself.
No, just read them to me. That's great.
All right. Okay, guys, it's time. Now, do you want me to go ahead and share the link to this page?
Yeah, because this is a really great gift, and this adds to this knowledge that I gave you today, and you can
Awesome.
watch it over and over again. And you'll be publishing this also, so they'll be able to watch it again because it's pithy. It's got a lot of stuff in it.
Yes. And then I want to also give them, now they need to go to that page to get the free gift though, right?
Right. That
Or
takes them
free
right
here.
to that page, but they are on our site, so then they can see, oh, I want to check out mini courses, or I want to check out this or that. They can see the other training that I have there, so they can explore the website
Fantastic.
by just going and using the bar up above that has the different areas. Frequently asked questions, how TechniTrader began, about us, that type of thing is all there.
Okay, let's see. You know what? The page that you're showing there is, do you want them to go to that page first?
They can go to the main website page, which is this one.
Okay, well, I was given a link and that's what I just put in the chat. But if you want them to come to this page, then I need the link for that page that you're showing right now.
Okay, I believe that this is this one right here.
HTTPS. All right, I'm going to try it. TTRAD. Oh, it's spelling counts. TT. Okay, guys, while I'm doing this, you need to get your questions put in there because, well, we have about 8 minutes, so it's not like it's crisis time or anything, but okay. It doesn't come, okay, that's fine. It'll be fine. It's not that page that comes up, but it's right there. There's a big button in the front, start learning, it's free. You have the same button there, that's good. And you can see the lesson content and the reviews. This is awesome. You guys, I happen to know that there have been remarks made already that are loving the content that Martha just brought to us. Okay, so I've got some questions for you.
Okay.
I don't know if you saw this, but Timothy said that's a nice way of saying it, the other side of the coin, to give institutions the benefit of the edge. You said that right around 10:06. And then he said, this lady is a gift. Incredibly informative. I would like to share the kudos.
I just love teaching the retail side, and I've had so many students that they start out with a really modest expectation, and they just go, "Wow, I had no idea that this information would really give me this much," because they've gone all over the internet and they've spent a lot of money on different things, but they're learning the same strategies and things. It's just not enough. You really have to understand what's going on behind the scenes, because we as the buy side institutions, we're the dominant force in the market. And if you understand us, and we care about you. I want you to be successful. If you're successful as a trader, it helps the stock market. It helps the economy. It moves things ahead. When the stock market is robust, you're making money instead of losing it. It's a good thing for everybody. It really is. And that's my legacy. I'll leave
That's
you.
fantastic. So Brenda's asking, is there a separate link for the mini courses, the 3 mini courses?
Yeah, I would go to www.technitrader.courses. And if you type that in, you can go right to the front page, and then you can just click on any one. They're just below the main picture going, "Hi, everybody, here's what you need to do." And you can see, I think you can see that part of them, and just scroll down. There's several mini courses that you can check out. These are the most popular. This is where I like people to start because it's really helpful, especially my experienced and advanced traders. You're wondering, well, I'm really make a lot of money and then sometimes I lose money. Okay, well, this is going to help you out. That's going to make a
That's fantastic. All right, so that I put that link in the chat for Brenda, and then I wanted to come back. We have a question. Mark wants to know if the SEC says only 1% of day traders are profitable. Are those traders manual or automated trading? And do you believe in mechanical trading only?
Oh no, the SEC doesn't let any AI anywhere on the professional side at this time because it's just too dangerous. HFTs are using AI, but all of a sudden I'm in the middle of earnings and this company has this great earnings report and it's gapping down. It's like, what is happening here? And then the next day, of course, it rebounds or goes up one day and then heads down. And so they're rapidly saying we have to have a structure for AI before we can use it. None of the trading floors use it except for routing. They have automation on their routing systems because they have so many ways that they can route. And they also have as many as 10 legs on their orders. So they have a 5 million order for Microsoft. They're going to swing trade Microsoft. Then they can use some option trades. So they'll leg on some option trades. They'll leg some E-minis on that attach to the S&P 500 that has Microsoft in it. Then they'll latch on to a software index or something else. So they can have as many as 10 legs to mitigate their risk if they think that's a risky trade. And they're swing trading. So they're holding for anywhere from one day to the next day, or more commonly 3 to 10 days. So they're swing trading and it's riding it up because they can push and nudge that up. And you'll see a white candle, then a little resting day, and a white candle, a little resting day. They're nudging that price up. And you just sit there and run it up. And then as soon as you see the time volume decline where they're starting to sell, there'll be a little candle, and then you'll have the spike of that indicator, that hybrid indicator will spike to the top of the chart, and it's still on the white candle. So the next day you can just say sell, and you're out as at the same time the professionals are. It's amazing indicator because it leads. It's telling you they're already starting to get out before the actual price actually starts to nudge down. It's really great.
Excellent. And then Brenda was asking, does the dark pool only happen before and after market hours?
No, it's all day long. They do, if they're going to do their big block orders like that 120 million, 25 million, 34 million, anything over 10 or 15 million, they're going to do that before the market opens. Since they don't display price, you won't see that differential appearing, and that order was probably delayed until after the market closes. So then it's hidden within the structure that I show you and teach you. And then because the national clearinghouses, once that national clearinghouse clears that order, it's available to everybody. So that's why they're allowed to delay it, so that the HFTs can't front run.
Cool. And she further wanted to know, can we see the dark pool volumes on our trading platforms such as Schwab, Fidelity, etc.?
No.
No.
The brokers deliberately, charting software, data is expensive. Data is very expensive.
Yes.
And so you're going to have to get a charting software program that costs you $30 a month. And you may think that's a lot of money, but that's super cheap because the professional traders spend $5,000 a month for their charting programs. You can get charting programs for around $29, $30. The brokers have a skinned down, and they don't have the proper aspect ratio. And you can't use a phone. You can use a tablet, you can use a laptop. I prefer you use a desktop, but that's okay if you don't want to, because you're gonna have to look at the charts and read them. And you can't read a chart on it. And what happens with the brokers, they skew the data, so it's not proper aspect ratio. You need the golden rectangle. That's that's a long-standing thing. A golden rectangle is the most pleasing to the eye and the most informative of any graph there is, and that's why it's used everywhere, including the financial markets. You have to have that golden rectangle, and I'll show you how that works. You'll see that pretty much everything on our website has that golden rectangle because it's pleasing to the eye, and you can see that. Yeah.
All right, Jan says, thanks, Martha. Great presentation and valuable market knowledge. And Dawn wanted to know, so you implied all day traders are not successful. What type of trading should we be doing?
You can't, it's going to be tough to be successful. It's a very small minority that are. If the professional buy side traders aren't day trading, then you shouldn't be, and they're not. So the sell side banks do swing trade. Day trade. I would recommend swing trading, momentum trading, or if you want active, exciting, fun daily activity. If you don't have time every day to trade, then platform position trade.
Cool.
Platform position trade, because you're holding a little bit longer, is a little bit more lucrative, and it's good for people who are stay-at-home parents, working from home, full-time career, that type of thing. Or
Awesome.
retirees who just don't want to spend all day looking at charts.
Which that you definitely don't want to spend all day doing that. So we
No.
got one from Timothy asking, Martha, do you think the premium leads? And on top of that, an indicator for the Dow called the PRYM, the PRIM?
Mm-hmm. No, the Dow represents 25 industries, not 30, and it's a lot of the companies are older. Some of them are very good opportunities right now, but the majority of them are really not doing very well. Even still, the Dow we have 131 industries in the financial markets, and the Dow represents 25. That's not really the stock market. That's why I do a special analysis of the overall market every day. And so they're missing out on a lot of them. And so it doesn't tell you what the market's going to do. I've had my market condition analysis scans for 30 years. And my students are always tracking because they want to see what percentage of accuracy I am. And they say, oh, Martha, you're 95% right now. Oh, Martha, you're 92% right now. It's like, ooh, okay. I don't care because I'm accurate enough that it's good because you're never going to get 100%, as everybody says.
We have some more questions here, but I think I need you guys to email Martha. Can they email you directly?
Sure. Let me see.
Or how do they get in touch with you? Because we're at 11:02 right now, and I definitely know that my
I'm
the
so
next
sorry I've
speaker is
gone
waiting.
over.
No. This was absolutely fantastic. When
Okay.
we have
So
so much engagement. Yeah.
what you want to do is you want to register on my site and say, I have a question for Martha from this trader's this information that we had here. So about dark pools. And if you do that, then I will get that. I will be sent that email and I will answer your question directly.
Okay.
Yeah.
So go to your site, register at TechniTrader.
And where it says something about experience level or such as that, say, I attended this webinar on dark pools. I have a question, and then just write the question in.
Okay. All right. Cool. Oh, thank you so much. That was
Sure.
perfect. Oh, Alexis said info@technitrader.com.
Yeah, info at technitrader.com will get you there as well.